Hey,
Good morning, good afternoon, good evening, good whatever it is, wherever you may be. And welcome to the latest installment of Tilton Talks Crypto. This week is actually the third in our series of SmartFi Community AMAs, Ask Me Anythings. And we do these occasionally to shed light on what we're doing and help our community out to better understand us and give them some kind of information and guidance along the way. We have a theme. This week's theme is smart interest. And as we go through it, who better to kind of lead us through it than the SmartFi co founder and CEO, Aaron Tilton? Aaron's with us, he's here. He's kind of the focus of this thing. So I'll hand it over to him as quick as I can.
thanks. I'm pretty excited about this episode. When I always get asked wherever we go, hey, can you teach me how to do X or do this? Or when should I buy? When should I sell? Or what should I do to build a portfolio of crypto and how to earn things safely? Right. So we built Smart Interest, and we'll get into more detail later here in the podcast about that. But built that as an easy way to get a return. And I guess I should say not easy, but a safer way and a simpler way. And also we need to give the disclosure that you've got to be an accredited investor here in the United States. But if you live outside of the United States, you can take advantage of that without having to go through the accreditation process. But this product had unique designs that we built into it to make it safer. We'll talk a little bit later about the issues that Celsius had. They had something that they would call, a similar product. That's what their business was built around. There are other companies that do this, but they're built differently and structured differently so that they couldn't stop out risk, right? And that's the big thing with SmartFi. We start with safety first, and this design around what we call a hedge. And we'll talk a little bit more about a hedge if you're new to investing or trading or any of these things. What does a hedge mean? We'll talk about how that applies. We'll talk about the concept of interest, right? And a natural rate of interest. And we're going to refer to the white paper and do some things. So we got some really cool stuff in here. And then I know later on in another couple of episodes, we're going to go through a step-by-step process, how to build a portfolio safely, right? With the tools that are available at SmartFi, because we have multiple tools that allow you to do different things to diversify your portfolio and learn how to do this safely, build it over time so that you're not, you don't have to become a day trader, right? Crypto should be simple. It doesn't have to be complex. So I wanted to make sure that everybody understood that. That's what we promoted, this AMA on, and then also ask the questions. We're going to talk about some concepts that might be a little new to people, or if you didn't understand, some of the things that we're talking about, ask the questions, right? Because we also need to understand what you guys need to understand in terms of conceptually what the products mean, how they function, what they do. So I'll turn it back over to you with that, Martin.
Yeah, further to your point about, in the future, talking about building a portfolio or something, to some extent, that's where I come in, because for people who don't know me, which is probably the majority of you, I don't kid myself, I don't pretend to be famous. My background is in dealing rooms, is in institutional trading, shouting and waving my arms about, as I like to say. I've been in and around markets, starting from that position for around about 40 years. And now, in addition to working as head of research for SmartFi, I've been writing for 10, 12 years for NASDAQ.com, and I write a daily market commentary piece for them. So I get asked these questions a lot by people about, building a portfolio and what's the best way to go about it. And I've spent decades literally thinking about this and studying it, and how you incorporate the techniques of trading into investing. Because if you think about it, there must be something to it, because it's often said that 90% of retail investors lose their money in the space of 6 months, or whatever the current survey shows. There's always a survey out there showing that. But there are thousands and thousands of institutional dealing rooms around the world, and they all make money. So what's the difference, right? So and part of that is the techniques and the things, and that's kind of what I want to impart to people when we get to that thing. But that's not.
And also the one thing I hear you often say is the difference between investing and trading, because they are very different things.
They're very different things, and if you don't understand that difference, then you're not you're starting at a huge disadvantage. So you have to understand the difference between the two things, but you also have to understand where they intersect. And there are places where they do. So we'll get to that, later on. And it's especially relevant to crypto, and it's relevant to what we're going to talk about today, because as you're seeing on your screen now, if you're watching our live stream, there are 90% of crypto investors lose money, is what the headline of this says. Now, I write headlines for my own pieces. I generally, therefore, take them with a large grain of salt. But there is this problem in crypto that people have come into it, to my mind, in the wrong way. And I know that you think the same way, Aaron, in terms of what they're not doing is assessing risk properly, looking at return in terms of the risk that's involved. They're not formulating a portfolio with a safety element to it. And that's where SmartFi comes in, right? And that's where the whole, perhaps people might better understand that if you give us a brief history of SmartFi, like where it came from and what it is.
Yeah. Yeah. And I also want to make a comment here, is that people losing money when they invest in crypto is not unique, right? Because also Forex traders, the SEC did a study, and I think this was 2017. Maybe I might get this a little bit wrong, but the SEC said that 95% of all people who start Forex trading lose all their money within 12 months.
I'm not so surprised. Actually, having been on the inside, I'm surprised it's not 100%. Because I've seen the level to which people on the inside abuse those on the outside. I mean, it was an unregulated, wild west kind of market when I got involved in it in the early 80s. Free floating currencies were only 10 years old, and nobody had thought to even regulate us at that point. So we front run every order. We ripped off every customer. And that wasn't, I didn't feel bad about it. That was my job. That's what we did, right? And so the fact that 5% managed to retain some money after 12 months, going as a retail trader in Forex, is quite surprising to me. But you can actually avoid being part of that chain, part of that system, if you take a sensible approach, which again draws us back to what we're going to talk about today.
The barriers to this, and this goes a little bit toward our founding, right? And how we kind of got involved with all this stuff. If you're going to trade against large banks, institutions, those guys, that's what they do as a profession, right? And so they're very good at what they're doing. They have budgets, billions of dollars. They can move the markets, all of these different things that they do. And as a single investor, you're not going to basically, have any kind of advantage whatsoever, right? So you have to learn, what is my advantage, right? And it's not trading. Trading is not the advantage, or having access to trade. It is time, right? And averages. That's what the average person can use that a trade desk doesn't do at the same time frame. So we'll talk about that later. But so the history of SmartFi really came about when our experience started when we started getting phone calls from cryptocurrency miners, primarily Bitcoin miners, looking for large scale power. Our company, up to this point, this was in 2017, was basically an energy infrastructure innovation company. We developed projects a little differently whenever we saw a company or some type of process in the energy infrastructure, like oil and gas, that had some advantage with what we were doing with nuclear power in our new nuclear power plant site. Basically we're power guys or energy guys in electricity. We would try to innovate around either some tax structures or the development timeframes, or de-risking something somehow, and build a strategy using existing structures. So for example, in the early days of the business, we used a section of the IRS code that nobody had used for nuclear power to be able to develop our assets and develop the power plant site, doing it under a structure that allowed us to put money in without having to pay the taxes related to the income. Basically, it was just a reinvestment strategy under the research and development construct of the section of the IRS code. we had to actually defend that in federal court. We went through massive audits and all these things that the IRS did to say, hey, well, we don't think you can use this section of the code like that. And we said, actually, we think we can. And it was all based on risk, right? So when we talk about trading and talk about the structure of de-risking things, this is what we do, or what we had done as a company in the energy space as well, as de-risking a site for a power plant, de-risking sections of the code to be able to apply that for the IRS and our tax liabilities. And this section of the code said, as long as you were undertaking research and development to discover risk that was unknown to you, then you could make a designation that allowed you to treat the investment as an expense instead of having to capitalize it. So you can immediately deduct that from any income that you were receiving at the time, right? So again, I'm not going to play that. There's a lot of detail, and we're talking about lots of attorneys and people that were in there, but that was our strategy that we built, and primarily myself came up with this strategy in this structure through our law firms. And we went to the federal court and defended this in a trial. And at the end of the day, the long story short is the IRS basically conceded everything back to us and said, you're right, you guys win. So this is what we did historically as a company, is de-risk things. So we started getting calls from miners wanting to know if we had power coming out of the nuclear power plant. It hadn't even been built. This is a long, long play for this power plant. But we said what we do have an expertise in is we can locate a site that has critical infrastructure and help you guys find a place to go mine cryptocurrencies. So we started undertaking those tasks, going to different states, working with other people in other countries, and started finding these sites. So we started developing this portfolio of sites. And this was in 2017. Bitcoin at the time was trading at about $1,500, went all the way up to 20,000, and then subsequently came all the way back down to, I think the lowest it hit was around 2,200, and then it kind of stabilized at about $3,800, for some period of time. But it was obviously off the highs of 20,000, right? It was worse than the correction that we just had. And so the guys who were dealing with us in these projects to mine new cryptocurrency, Bitcoin and new cryptocurrency facilities, all of a sudden they had, 1/20th of the value that they had before that they were planning on funding these projects with. So what we decided to do is take their cryptocurrency, hold it as an asset, and then lend them dollars to continue to build their sites. And this is a technique that we brought across from our oil and gas kind of experience that we saw in the same structure, where you could build a derivative on a future, or in this case, it was a forward contract because they're not exchange traded. And then you could go out, get a certain amount of funding from it. And from that funding, you could build the facility and kind of build this out. And we noticed that the decline rate on an oil and gas well was very similar to a cryptocurrency miner, right? They had a period where they peaked in profitability and then they came back down. So again, I don't want to get all, probably got way too into the details, but I want people to understand that the unique approach that we adopted from multiple industries, primarily based in the energy or commodities industry. And we don't look at cryptocurrencies as really a currency. We look at them as commodities. And so does the SEC. The SEC has said Bitcoin is a commodity. It's not a currency. If it was a currency, it would have a bank. It would have all these other things that basically structure around it. We'll get into those. So that background informed us as how to build financial products that had safety first, speculation second. Right. And most people, in fact, all people that we know of still up to this point, they approach cryptocurrencies that way, where they speculate first and they can never really get back to a hedge. Because if you don't have some correlation to the dollar in a way that allows you to engage in a financial product with safety, it's total speculation, and you're basically naked and subject to the whims of the market. So you're going to lose money during certain periods of cryptocurrency market volatility, because you're exposed. You have no safety. You have no security, right?
So getting to that point about, for most people in the investing world, and certainly for institutional investors, safety usually means going to things that pay interest rather than things that you're speculating on capital appreciation. And we're talking about smart interest today. So let's get to the kind of meat of what we're talking about. And I'll ask you a very simple question that is part of this AMA, but is really at the heart of what we're talking about here. What is smart interest?
Smart interest is a product that allows you to take either Bitcoin or Ethereum, put it on our platform, and then receive interest for basically locking it up or staking it. Those terms are maybe a little different. It's not really staking, and we don't require you to lock it up, but you basically put it on the platform, and then we utilize it in different structures to generate a return on it or a cash flow. And then we equalize that cash flow, and then in return is expressed in an interest rate that you can earn. So we publish that from time to time. It doesn't change rapidly, but it does change, every couple of months we change it depending on certain conditions and what are we doing with the asset, right? So that's basically at its core what smart interest is.
Understood. And so for me, or for anybody out there who's a holder of Bitcoin or Ether, or why would I? What's in it for me? Why SmartFi? Why would I why would I put my holdings with you guys? What's que bueno? How do I bueno? Yeah. What's in it for me?
Yeah. So basically, you get rewarded for putting that crypto to work, right? And let's say you can put dollars in a variety of instruments, like a bond or a treasury bond, or you could do different things, and you receive some rate of interest based on what the treasuries yield. If you're a short-term bond or a short-term treasury, a long-term or whatever, it has a rate of return based on what the government does in borrowing for debt, right, to fund the government. And in that case, it's the same thing. If you're just holding your Bitcoin in a cold wallet, you're not making any interest, and you're exposed to the market, just the volatility of Bitcoin's pricing as a whole. And so there's a way to actually generate some yield and engage in that process. So it's not just sitting there. You're maximizing the return on the value of your crypto.
Right. So what return can I expect? How much can you earn? What do rates look like? Yeah.
So in the sense of Bitcoin and Ethereum, they're in the single digit ranges, anywhere from 1.5% to 3%, depending on what's going on in the market, what we're doing with it. And then also on stable coins, I think we're paying out about 6 or 7%, depending on what's happening. So those are the choices that you have. And we engage in other financial transactions. For example, we loan against Bitcoin. So you can take your Bitcoin, we go through a process to convert it with a hedge, right? So we hedge everything as it comes in, but we would hedge it and then generate dollars to then lend against more Bitcoin. So if somebody else needed to borrow money and you had Bitcoin to lend, but somebody needs to get to dollars because they need to buy something for their business, right? And we primarily make loans to small businesses, right? So we can convert this in a series of transactions that hedge it so it's safe and you don't lose basically your Bitcoin, or is not exposed at that structure, and it's hedged. Then we convert to dollars, and then that person can use their dollars. But then the Bitcoin that you put in is actually backed with other Bitcoin that comes in with people that borrow against it, right? So it's this safe kind of structure. And when we'll get into some discussions around Celsius, where those guys are not doing that, right? They had naked exposure, and that's what led to the collapse and all these crazy things, right? But what it does is when you have naked exposure, you can basically take every deposit and then try to go get a return without a hedge. That's incredibly dangerous, because when the market is running up, it's okay because there's no short exposure. But when the market goes down the other way, it's cataclysmic, right? And that's what happened to Celsius. That's what happened to other guys when they were not doing these hedges. And if you're not hedging, yeah, you can go out and try to get for a time maybe 16 or 19% rate of return. We saw Luna and Terra and all these guys doing these same things. Well, it's just, they're basically trading dollars and crypto with each other. And eventually the music stops, right? And the chairs are yanked out because the market, when it goes down, they have to pull chairs out because the value has dropped. And there's no longer these 19% rate of return. And frankly, it never existed in the first place because it counted on the fact that Bitcoin and Ethereum and cryptocurrencies were running up all along the way, right? So this rise in cryptocurrencies, they're just playing off that increased value to give this 19% rate of return. So when it goes back down, it crashes, and now they have a negative short position that they can't cover, and they have a negative effect on their balance sheet.
So let me just point out something that, like, basic to me seems absolutely basic, because I've been 40 years in and around the market, but which people often forget, and it is just the one of the ultimate truisms in the trading world and in the investing world. Reward, whether that's in the form of interest or potential trading profit, is always about risk. It's proportionate to risk.
Yeah, okay, commensurate with risk, for sure.
It is, absolutely. And so when a crypto lending platform or whatever it might be offers you 19%, the first thought that should be in your head is, I have a pretty good chance here that my investment's going to zero. Yeah. I'm going to take a gamble on the fact that maybe I can get enough back in a short space of time and get out before winter comes, and I'll be fine. But if you go into it with that at the back of your mind, then, far be it for me to tell you what to do, right? You're quite entitled to take that risk.
You're going to take the risk. Yeah,
absolutely. But if you're going to manage risk, if you're going to, and when again, we're going to come back to this conversation, we're going to have a future time about building a portfolio. Building a portfolio from an investment perspective is not about just piling on risk. It's about diversification. It's about all sorts of things that actually mitigate and minimize risk where you can. And so it seems to me, based on what you've just said, that SmartFi's approach to paying interest on crypto is in that kind of second category, if you like, of managed risk, where I know that that's part of SmartFi's loan portfolio is into small businesses outside of the crypto world, backed by real world assets, etc. That's a form of diversification that minimizes risk. Now, are you going to be able to offer 15, 16, 20% return? No. Absolutely not. But at the same time, if things go what we used to, no, I won't use the phrase. There was a phrase for it in the market. I won't use, because we're not quite FTC censored.
Yeah, exactly.
Yeah, when it goes a little bit pear shaped is another one we used to use, right? That you have something that's responding to different stimuli to the crypto world underpinning your portfolio, but in order to do that, you're going to sacrifice some short term return in favor of longer term safety. And I think that's really important.
I would actually put it just a little bit differently, because think about how long, Terra Luna, that they were offering this, in Celsius, they're offering these, crazy returns. And sometimes they weren't crazy because the yield wasn't there. But let's just say if somebody tells me, hey, I can get a 20% return somewhere, and you're like, well, how long will that last? Maybe I'll get in for 6 months and then get out and then go to something normal. Your average return is probably about what you would get anyways if you would just put it in something that was safer. Because those returns don't last. Frankly, they're really not there. They don't exist, right? You think about everybody that lost funds in in Celsius. Did they really get a return? No, they lost. They lost principal. They lost everything. They wiped it out. So when you go into SmartFi, we're doing things that are uncorrelated assets, right? Some real estate, some equipment loans, all of these other things. And when you keep it in for the duration, and you can kind of check out and not have to really sit and be concerned, or you don't trade it, all of these things, it's safer, it's stronger, it's better. And you're actually getting a return, when in the other case with these guys at Celsius, they chased those large returns, but they really didn't get anything. So we just don't do that, right?
Two things. Firstly, I think that what you've just done is answer a question that came up from Really Info, which was, how long should I keep my funds in the interest account? I think basically based on what you just said, the answer to that question is as long as possible, as long as you feel comfortable with, because the longer you keep it, the more you benefit from that diversification of risk and so on. That's the first point. The second point I wanted to make was we had a conversation before we went on air today about these subjects, and just the two of us having a conversation. And I was trying to work out how you gauge. I was trying to work out how you gauge what is a reasonable, what level of risk am I taking? And I pointed out that I wrote an article for NASDAQ this morning. You can go and find it on NASDAQ.com, not to self-promote, but you can if you're interested, on the subject of Turkey and why investors should be keeping an eye on that as we're all watching the Fed, because you may have missed it, but someone like me who's a central bank geek would have followed it. But this morning, around the world overnight, what happened was every central bank out there, pretty much, with the exception of Bank of Japan, but there's a different situation there. Most of them anyway, sort of followed the lead of the Fed and hiked rates overnight. There was one notable exception, and that was the Central Bank of Turkey that cut a full point off their rates. Now, you might think, okay, that's obviously because Turkey's in this amazing economic situation. They're strong. They don't have inflation. Everything's good in Turkey, right? You'd be a little bit wrong. They actually have 80.2% inflation based annual inflation based on their August. That's 80.2, not 8.2 or 18.2, 80.2% inflation. And their currency, the Turkish lira, has lost 80% of its value against the dollar over the last 5 years. Yeah. So, and the country is, and then their foreign exchange reserves have been massively depleted. And so you could make a point that the country is kind of on the verge of collapse, economic collapse, right, of bankruptcy. And so if you're going to invest in that currency and in that country, obviously you're going to want a really good return, right? So what does the global market see as a really good return? What are you going to get if you invest in Turkey? 11%.
Yeah.
Now, in the current environment.
How long?
Yeah.
And always have that threat hanging over your money of like, is this the month that it collapses, or is this the month that all comes undone? Yeah.
That's a little misleading, because that's what you're going to get if you just buy bonds direct from the government, and you're not going to. So you're going to get better than that. But the point I'm trying to make is, when these crypto companies offer you 16 to 19%, understand that the risk you're taking for is not necessarily, it has to be measured somehow. And if you think of that, even if you're getting 16, 17% on your Turkish bonds or whatever, given where they're at right now economically, they're not in a great place. And so, why do you think it's any different? Because this is a decentralized protocol or whatever.
Yeah, that's one of the things that we saw. In fact, we had a very high net worth client who was saying, "Hey, I'm going to get some better rates." So he pulled some of his stuff out of SmartFi's smart interest accounts, and he was going into DeFi protocols. And for 2 or 3 months, a couple of months, they were getting, these returns, at least their balances, knowing that they were going up, right, in these protocols, which people have to realize there's a big difference between unrealized and realized P&L, right, a profit. And if you don't convert it, you don't pull it out, you don't get it off the platform, it's still all at risk. And so you've really made nothing until you take it off, right? So they went and did this, put, I don't know the total value that they put in there, but I can tell you that they lost hundreds of thousands of dollars. And we told them, it's not real. Don't put your money there. But because of the word DeFi, or the acronym DeFi, and that it is quote unquote controlled by software, and that it's somehow altruistically, ideologically more pure, that it would not have risk, or that it can't fail, or these kind of things. That's not true. I don't know that there's a big DeFi platform out there that can tell you with 100% certainty that they don't have a security vulnerability in their smart contract. A lot of them have been hacked, right? So there's that risk. But then there's the market risk as well, that most of these DeFi platforms are built on trading, right? So when the price of crypto goes down and all the trades go wrong, and there's leverage and all these things going on, it'll collapse rapidly. And that's a big difference about what we do with SmartFi, is that we've diversified our portfolio of these structured things that we do. We have some in real estate. We have some in small equipment loans, right? So when the cryptocurrency markets were collapsing, and falling off, we had, roughly 1/3 of our portfolio in markets that didn't have any impact or any effect because they're totally uncorrelated to cryptocurrency markets. Now, that doesn't mean that real estate or small business loans with equipment or those things won't have some problem. They all can. Every asset class can have risk, but you don't want them to all have the problem at the same time. So you want to be diversified, right? Which is kind of what we do in that structure. And we do it with basically a hedge. And then there's sometimes some correlation that allows us to actually generate a higher yield, right? Depending on what's going on. But all of that has to do with being diversified, and not going all in. I mean, it's one of the most basic tenets of investing. Don't put all your eggs in one basket.
Yeah,
right.
Absolutely. We're getting a huge number of questions coming in, which is great. This is what we want, right? We want audience feedback and everything else.
Yeah.
So let's try and deal with one or two of them. And there's one in particular that caught my eye because it's on a subject dear to my heart. So if I can just scroll back down. I think I don't know if I can scroll down this list of questions. Can somebody help me out here? There was one earlier about central banks and whatever. If you could just pull that back up for me.
There's one here that says, how do you plan
from Stefano. Yeah, from
Oh,
Stefano.
okay, yeah, that one.
How do they plan to deal with the problems of failed fiat money systems since the inception of fiat currency and with central banks being manipulated by government policies? I assume when you say that, when Stefano says they mean we, SmartFi. And my first time, you're going to be better qualified in some ways to answer this question directly about what SmartFi intends to do. I just want to make a couple of points here. The first is that one of the things about smart interest that interests me most, if you'll forgive the pun, is that it is dependent on what in SmartFi's white paper you refer to, Aaron, or this white paper refers to as a natural interest rate. Right? There is this theory that anything that is interest bearing, and that would include government debt and bank accounts, whatever, everything has a natural, discoverable interest rate, which means that it offers a natural return based on real-time data and where it's at any given time. The problem that we've had, and I don't want to sound like I'm this ban the Fed guy, because I'm really not. I understand that they have a role to play and whatever, but one of the inherent problems that hasn't been addressed for the last 50 years in the central banking system is that a central bank's job is primarily to distort market rates. Right? When I was in the Forex market back in the early 80s, we saw it every day, right? Central banks would come in and buy and sell their currency. There's nothing Bank of Japan did last night, by the way. They haven't done since I was in the Forex market in the 1980s or whatever, that they actually intervened in the market to try and control moves in their currency. Now, a few weeks ago, we spoke about how that inevitably ends when I talked about being in a dealing room on Black Wednesday when the Bank of England folded. Right? That doesn't work. But these central banks feel that it's their main aim, their main function is to distort markets. But there's an inherent problem in that, because if you do that, there is no discoverable natural rate. We don't know where it is. We have no clue where it is. And
it's a theoretical construct, right? The natural rate of interest, because there's no mechanism to measure the indicators, right? And measure the actual micro data that actually does give you the indication in real time. When somebody's buying something, are they willing to pay less or more for it? That'll tell you if there's inflation. But there's no such thing, right?
No, that's what intrigues me, and that's one of the things that I particularly want to point out about the difference in smart interest, because smart interest it cannot be manipulated by the central bank. It can't. In fact, because rates on the loans from SmartFi are ultimately going to be set by the community, if I'm correct in my interpretation.
Yeah.
Right.
Yeah.
So
eventually,
what's really happening is that we, the SmartFi community, become our own central bank.
Yeah. And so if you read the very first page of the white paper, right? In fact, the cover page, right? Maybe Paul can pull that up, our producer. But that is the goal right here. SmartFi, an open lending platform with decentralized cryptocurrency monetary policy. So when you talk about, the definition of monetary policy, that's what central banks do, right? They set monetary policy. Governments set fiscal policy in the terms, with taxation and other things. And then the two interact basically to create this distort markets, to influence them, to engineer them, for good, quote unquote, for the good of the people. So in this structure, and this is I'm going to try to be very short because we can get super bogged down in a lot of the details. So for Stefano on Discord, make sure that you go through and read the white paper. There's a whole section on these topics about what we plan to do, because you don't need one cryptocurrency, you need two, right? And then that structure for the natural rate of interest will be discoverable, because on a blockchain, now you have the ability to look at every transaction. If you put a code in each transaction, you could see what was going on with people buying food, buying real estate, doing all these different things. So you structure that in there. And now you have the macro data that's rolled up from the micro data to look at things almost real time. It's near real time, right? So, but then also having two tokens, right? SMTF is a speculative one, which basically returns capital appreciation from what the market perceives it's doing. And that, again, gives you the ability to go to the natural rate of interest from the market influence. And then from the stablecoin aspect, you have these codes that allow you to look at what's actually happening on the micro data level. So now you can combine micro with macro data and look at that stuff real time. And instead of having a central bank basically control this policy, on monetary policy, the DAO basically, and SmartFi will be created and converted into a DAO here shortly over the next probably year. We have some legislation that we're going to be working with the state that they'll recognize it and do all these other things that allow us to basically be formal recognized. But the DAO, or a SmartFi token holder, will then be able to vote on the rate of interest, and they're the ones with everything at stake, right? So when we use this concept of blockchains, it's who has something at stake, right? Who has something to lose, and then who wants to use it for the transaction. So you need a stable coin, speculative coin, and then the DAO that's controlled by the decentralized protocols to basically structure all of this so you can steer this economic ecosystem with those people that have things at stake. So that allows us to basically end up with a currency that can be decoupled from a fiat currency structure like the USD eventually. So that's a long, way of explaining that, Stefano. But that was an awesome question. Shows the level of detail or understanding that Stefano has about what do you do. And we had that same question over the last 5 years, and that's why we built a system to basically it can stay pegged, but not through a peg, but through economic activity, but then decouple when it's advantageous to decouple.
It's fascinating because that question that Stefano asked was basically one that I asked you this morning, and you kind of explained it to me in the phrase that went through my head as we talked about it was that, what SmartFi ultimately will deliver is monetary policy by the people for the people, which is kind of a cool
absolutely.
Yep. Let's move on a little bit to another question. Okay. And so I was actually intrigued by a couple. One of them was about the mining of the stablecoin, and I know that's not technically what we're talking about today when we're talking about interest, but I know it's a subject a lot of people are interested in, and they're waiting for some kind of development. So if you could just put that back up on the screen so we can see the exact wording of it, and I'll read it again, please, Paul, if you could. Yeah, so it's from Omar K. I would like to ask Aaron about mining SFUSD. When will we be able to start mining, and which algorithm is it going to support? A CPU mineable stablecoin would be great. Thank you. So do you want to address that one, Aaron?
Yep. So the actual SFUSD blockchain has already been running for almost 2 years. In November, it'll have been running for 2 years. So we've built it already, right? And so that structure, the stablecoin is designed to be used two ways. One, to be minted, and two, to be mined. So there's a pre-mined structure to it, or pre-minted, sorry. But then it's mined through the lending process. So we have a mining pool that allows people through what we call the commodity layer protocol. And if you read that in the white paper, you can get the details of what is the protocol, right? And how does it work? How is it structured? And it's based on two key concepts. The first is instead of mining something with a predetermined reward, and if everybody kind of thinks through that, think about this. If everybody's rewarded the same for the same activity, regardless of their efforts, right? Now they have to have a certain, machine. We talk about that, but when you look at what Bitcoin has done and all other mining protocols, they're basically built on a socialized concept. It's not a free market because of the difficulty ratings. So because of our experience in mining, we've built and financed mining facilities with other people and projects. And basically at one point, we helped fund almost 10% of the Bitcoin network through a specific client of ours. So we understand this really well. What we learned is that you needed to structure something so that you couldn't just throw a bunch of hash rate on. It had to be, the hash rate had to actually be construed or correlated as a hedge to the rewards on the network. So in the commodity layer protocol, that's what does that. But then you have this issue of, well, does it secure the network? Because that's what the hash rate is for, is secure the network. So we implemented a process of what's called merged mining, right? So we did a Namecoin fork, implemented merged mining. So the algorithm currently for the SFUSD network is SHA-256, same as Bitcoin, Litecoin. And that allows us to write the headers of our blocks inside of the headers of the blocks on the Litecoin network, so that we don't use hash rate to secure the network. We're using the Litecoin network to secure it. So it makes it super efficient in terms of resources, right? And then it is the cheapest miners win in the commodity layer protocol. And what they're doing, instead of mining a fee, which distorts the ability to do a transaction on the network, we don't charge fees. What we do is we allow a reward correlated to the interest on our loans, right? I know that's a lot of kind of jargony things in there.
It is.
But,
I just want to make one point. If
yeah.
To the people out there listening and watching, if you wake up in the morning and hear that a very large percentage of the crypto community has thrown themselves out of windows and in other ways committed suicide today, it's because Aaron just pointed out that Bitcoin has a socialized element to it. That will have horrified so many people in this world.
Yeah, they're like, no way, that's not true. It is true.
Especially if they actually followed along with what you said and realized that you're speaking the truth, right? So
yeah,
they will have
the
just
source
been,
of all volatility.
I'm not part of a socialist system.
Yeah,
it's not socialist, but in a way, it's socialized. And that's something that a lot of people overlook. Anyway, we've got to get on to other questions.
I want to make this other distinction here. It's the source of all volatility in cryptocurrencies, right? Is that you can't produce the commodity, which is the coin, at a rate stable to the cost.
Yeah.
Right. So we solved that problem because we were building derivatives, financial derivatives for miners to help keep them in business. And we realized, they're basically coming to us for a hedge, and we couldn't complete a perfect hedge, but we got good hedges. And we said, look, if you tweak the mining protocols to do this, it'd be a perfect hedge because you would be mining US dollars or a dollar denominated coin. So when it came out, it would never fluctuate after that. Now you can take the dollar and go speculate on other assets. Totally different, right? So read the white paper. Your eyes are going to bleed, all these other things, because we start with safety or hedge first.
Incidentally, over time,
when is it going to be available? Next year. I can't release the actual date just yet, but all of these things are being built, right, with our blockchain partners. Next year, that'll be available.
Okay. So let's get back to a more relevant to the subject and shortened, fairly easy to answer question from Soulsby's Dude, asked on Discord, how do you calculate crypto interest? So how do you calculate it?
Let's see, Discord, how do you calculate crypto interest? Okay, so I'm going to pull up my screen right here. If I can get to it right here. So I'm logged in. I'm going to go to the Earn tab. Let's see. I guess I have to share my screen.
Yeah, I know this is something that is actually covered in the pages of smartfi.com because it's something I read myself. But it is an interesting question, and not everybody's going to go to the page to look up the answer. So I think it's an interesting one for us to deal with here and now because it's not a complicated answer, really, is it?
Yeah, it's pretty simple actually. So here's the smart interest calculator. Obviously gives a disclosure about being an accredited investor if you're inside of the US. But basically you're going to click here, pick Bitcoin, Ethereum, USD, or Tether. And then it's going to tell you what the interest, the rate of interest. So Bitcoin, you can see what it is currently. Let's go to USD. All right, there's the USD rates, 7%. And it actually, the more SMTF that you hold, the better the interest is. That's the smart, bright, brilliant, and genius ratios based on the rewards for owning SMTF, right? So you would just put in here how much you want to deposit, click start earning, and away you go. So it's really, really simple, right? But those are right here. So it's Bitcoin, Ethereum, USDC, and Tether, and it's pretty straightforward.
That's how you, as a customer, as a community member, calculate your interest. As to how the interest paid is calculated by SmartFi, I think we've kind of covered that. That it's a function of the work that the deposited money is put to, basically. That's a kind of a wordy way of saying it, but hopefully you understand what I mean. So as I said, we have had a flood of questions, but we did have some questions like pre-submitted questions that we wanted to get through too, and we're going to come across time as our enemy because we've only got about 10 minutes left in this. So some quick fire ones, right? What crypto can I earn interest on?
Yeah, and we just basically answered that: Bitcoin, Ethereum, Circle, Tether. Right? Okay. And the reason we don't have 90 different choices is because you can't create safetier hedges with these very speculative altcoins, right? And anything that we would do, there's no safety. There's no, you need volume to be able to create a hedge. So if something goes wrong in the market, and I've got this, very small, weird coin that we're, paying interest on, one, I can't create a hedge to structure it so I can lend it, on a tractor or something somewhere, so we stay to the safest, highest volume stuff that we can so that we can create the hedge.
Right. How often is it paid out? Good question.
Weekly.
Weekly is pretty good if you've ever held a bond and waited for your quarterly.
Yeah.
All right. What's the lock-in period? This is an interesting one to me because I know the answer to it, but what is the lock-in period?
There isn't one.
That's it. That's all you need to say, Aaron. That is it, right? There isn't one, folks. You don't need to tie up your money for 2 years with us to get a return. You just need to deposit it, right? And do you have a minimum balance?
No.
See, I love these questions. They're
pretty simple. It's just pretty straightforward.
And the answers actually all taken together constitute the reason that you should all be funding your SmartFi accounts, right? Because you don't have a minimum, you don't have a lock-in period, you get paid interest weekly. It's interest that's based on a hedged relative. I can't say safe because nothing that has a return is safe. Because remember what I said before, right?
Yeah.
All right. So there is one here that just caught my eye that just came in, and we really do. We've got some other subjects we need to get to, but this one kind of. Okay. So Nissan Sala. Forgive me if I actually butcher anybody's pronunciation of anybody's names here. I'm doing this on the fly. But Nissan Sala on Discord said, could you elaborate on SmartFi's governing system? Are you a community-driven project? There's some more to that question, which you may or may not be able to see, but that's an interesting question to me. So SmartFi's governing system.
I want to answer another one that I saw in there. We'll get to that. It's talking about the smart cycle, right? And its duration, or why is it stalled, right? And we'll talk about that because that is a key component to all of this stuff. It's actually working exactly like it was designed to do, and we'll get to that in a second.
Let's deal with that first, because I think it's important that we don't run out of time before we get to that one. And part of the reason is because on the surface, that sounds like a somewhat hostile question, doesn't it? Why is it stalled? And yet, number one, as a company, SmartFi is not going to avoid that kind of question.
Yeah.
We're not hiding anything. It's transparent and it's real, and so of course we're going to deal with it. And I don't want the person who asked it to think, oh, well, I asked a difficult question. That was Pontiac, I believe. So I don't want them to think, oh, well, I asked a difficult question, so they avoided it. We're not going to avoid it. So Aaron, give us your answer. Why is it, and why is it actually almost like by design? Or not by design, but why is it the thing working as it should?
Yeah, I mean, it is designed specifically for that reason because, one, SMTF does not pay a return, right? When you buy it, SmartFi isn't giving you an interest rate like we do on Smart Interest, right? It's totally different. But it works in a very similar fashion. That is part of the hedge structure, but it's also what creates the deflationary aspect in terms of the what I would call credit creation function. And I'll try to be really quick about this. What we noticed about Bitcoin in our years of mining and funding it, creating derivatives and all these things, that essentially 80% of all Bitcoin sat in wallets that never moved. 20% of the Bitcoin that was being traded in the market set the rate for the rest of the 80%. And that was the credit creation function that made the other 80% worth more. But it was unrealized. Those gains are not realized. It's not real, right? Until you sell it, until you're not long, until you're short, you don't realize the gain in an asset, right? So everybody that, when they had all their Bitcoin, it ran up to 60,000, almost 70,000. Everybody's like, oh, I'm worth X. No, you're not. Not until you sell it, right? And you get to a home hedged currency like a dollar, right? So in the credit creation function of SmartFi, we took that same concept, used a deflationary mechanism, but that deflationary mechanism is market-based. We don't control it. It's an algorithm that's structured and set. So on the smart cycle, if there's no demand to buy it, it stays at the top level, right? And then what that does is it drives people to go buy it in the secondary market, which means it's cheaper in the secondary market to buy it there than it is on smart cycle. And it's supposed to be that way so that the capital appreciation and the realized P&L of that, or the, when you want to sell it, has to transfer to the secondary market. So anybody that's holding SMTF right now, it's worth roughly, I think between $1.15 and $1.50, depending on which exchange, either Probit, the DEX, Atomic DEX, or on our secondary exchange. Don't buy it on the smart cycle. Don't go get it there. Go buy it on the secondary market, which has the effect of running it up on those markets. And when then those markets on the secondary exchange exceed the smart cycle, people would start going to the smart cycle to buy it back again, because then the supply would be in equilibrium with the demand. And then it would run it back up, right? So it utilizes this kind of balance, right, of this structure between stable dollar balances and SMTF variability. That is by design. We want it to be that way. And then if there's enough dollars to fund loans in the market, what we're doing a SmartFi, then we don't need people to be buying it on the primary cycle, right? The smart cycle. They need to go buy it on the secondary market where they can get it cheaper. So these are arbitrage opportunities built into the structure so that you can generate a return, but the return is not coming from us. It's coming from the market. That's that natural rate of interest that we talked about in the very beginning. It's designed that way.
Yeah, it is amazing. I do want to kind of, I want to be sensitive to time, because you and I can talk about these subjects for a long, long time, because we're both geeky enough to be really fascinated by them. But we did tease at the beginning that we talk about Celsius and that situation in things, and to me it is an interesting thing. I wrote a piece that we're trying to think about where to use it right now. But earlier on, when I talked about Celsius in terms of other, meltdowns in the financial world, and I think when it happened, people weren't thinking of it that way. So this, what people were saying was what the narrative out there, certainly on the mainstream media, was, hey, this just shows the Celsius bankruptcy, the Celsius failure, 3 Arrows Capital, all of it just shows that crypto is a scam, is not valid, is this, that, the other. What they didn't say was, okay, this is just what happens in every single market. Nobody said, because back in the day, Nick Leeson, bankrupt Baring Brothers with, excessive risk, nobody says that it was actually like that there was a problem with the US dollar or with the British pound or whatever, or the global financial system. It was one piece of irresponsible stuff, right? And so, you get that, right? And then you get, the London Whale and the
Yeah, people
lockdown.
manipulate the system and use the advantage of the holes and whatever they can do. I know
Yeah,
we're super short. I can answer the Celsius question really quickly. They were naked short their entire portfolio. They had no hedge.
yeah,
That was it. So they incurred massive losses, right? They didn't think through that stuff because they were trying to outperform the market and entice people for deposits. And they were taking in so much crypto so fast. They had no correlated hedge or no structure to build it in. We don't want to grow crazy levels because we don't need that to basically improve the value of SmartFi. That's in the token. We've got this natural rate of interest and these other things that we do to equalize that. We already had 4x return or growth in the token when we started from where we are now. Now it's back down. Go buy it from the secondary market. Don't need to buy it from us, right?
yeah. And again,
I know we have this other one that we didn't get to. Could you elaborate on the SmartFi governing system? That'll be a whole nother podcast and a whole nother thing. But the governing system is built in who owns the SMTF. And right now, SmartFi owns the majority of that, right? As it's our token, we built that. But over time, as people buy SmartFi tokens, that voting will be structured in your wallet on SmartFi. And the people as a DAO that are involved and hold the token they will drive that, right? Eventually, we are setting the interest rates right now because we have the most to lose and we have the most at stake. We own the most SMTF tokens, but over time, that'll transfer. And then also just on that same vein about the happy birthday for SMTF.
Yeah, that's Paul, our producer, subtly reminding us that we were supposed to talk about this.
Yeah.
We've been chatting away, forgot all that. We actually this past week, since we last spoke to you, we've celebrated a birthday at SmartFi. It was the 1 year anniversary of the SMTF token, and I wrote a small tongue-in-cheek piece about it, saying that our little baby is all grown up, and we've thrust an awful lot on our baby's shoulders in its year of being. Since being born, we've asked it to
provide a safe, all of these things. Yeah,
we've asked it to provide a safe crypto environment for all those people out there, and this, that, and the other. A lot to ask of a 1-year-old. But there is, joking aside, there is a kind of a serious message here, which is that when you think about the timing of the inception of SMTF a year ago, just as crypto was entering a very deep winter, and the fact that we're here talking about it, we're still doing it, it's still going. That just underscores everything that we've talked about today.
It works as designed, and it was tested right out of the gate.
Yeah,
the buyback guarantee is still intact. All of these things are there. It's working just like it was designed. And I would say this: yes, it's a year old, right, since it was released, but it was 5 years in the making.
Yeah,
right. And we tested all of these things with transactions and things that we were doing with high net worth structures with our clients and all of these different things, our trade desk, everybody. The hedging process worked. We got to safety, everything worked out. And now going forward, we're poised for the growth next run up as we talk about, that. But that's a whole nother AMA and a bunch of other things.
We've got lots of we've got things we didn't get to this week as well, and that will always be the case. Just a quick reminder. If you like what we're doing, if you like what we're saying, if you find it interesting, if you're geeky enough to follow along with us, then please subscribe, comment on whatever platform you're on. Those things really do help us out with the algos. They help to drive the message. They help to get people involved. The more people that get involved, the better off we all are, the stronger the community is as it becomes larger. So remember, we are the crypto community that funds loans. Get in there, get involved, buy SMTF, do what you need to do to be a part of it. All right.
Thanks, Martin.
I think that's about it for this week. And we'll be back next week when we'll be waffling on about something else, I guess.
All right. We'll see everybody then.
See you then.